Okay, welcome to this evening session. We are going to be looking at working capital and cash management. Okay, so the outcomes that we're going to be looking at is calculate the level of working capital in a business, identify and explain the dangers of overtrading, demonstrate an understanding of the effects on cash flow of external internal events and actions, prepare a trade receivables collection schedule, as well as a trade payables settlement schedule. Describe the benefits of budgeting, outline the budgeting process, explain the concept of budgeting in business, and monitor and control actual expenses and revenue against the project's expenses and the revenue. And we will also, next week, we will continue with this. So some of the outcomes we'll address next week. Okay. So working capital, if you take your current assets and your current liabilities, okay, so those form your working capital. So current assets, we have our, our bank, which is our cash. We have our inventory, and we have our debtors. Okay, so that forms part of your working capital. And how do we finance that? We finance it through creditors and other methods of finance. So when we look at a budget, budget is where we say, okay, what are we planning to do the next period, whether it's a 1 month or a 12-month period. Normally a budget is drawn up for a 12-month period. You can also do it for longer periods. 13, 14 years ago, I worked for about a year in Angola for Bollywood Equipment, where I did a budget for them for 5 years, a strategic budget, and then a 1-year operational budget. And in your operational budget, you say, okay, this is my income that I plan to get every month, and these are my expenses we are going to have every month. But now that's a general budget, and then you have a cash budget. So with a cash budget, we're looking at our cash we will be receiving and the cash we will be paying out. So that's very important to understand that it is cash flow only. So if you look at your normal budgets, or if you look at your typical income and expenses accounts, you will have things like depreciation, you will have bad debts, you will have provisions. Now, those are not cash items. When you write off a bad debt, or when you do depreciation, there's no money coming into the business or going out of the business. So you will ignore items of such a nature. Okay? We only deal with cash inflows. Now, when we say cash flow is key, I think I've said it before that I was taught the 3 main important things on financial management is cash flow, and then cash flow, and then cash flow. Because without cash flow, a positive cash flow, you cannot pay your expenses. And you need to pay your expenses. If you don't have cash flow, you can't buy stock or inventory, can't pay salaries, you can't pay your rent. You simply cannot operate. Okay. So that is the importance of a cash budget. So in a cash budget, we want to see, okay, how much cash are we getting in? When are we getting it? And when are we paying it out? Okay, so that is the important thing on capital budgeting. The cash budgeting. Okay, so if you look at working capital management over 12-month periods, we look at inventory that will affect your cash flow. When you buy inventory from your suppliers, it's going to cost you money and you will have to pay for it. Now, normally suppliers will give you a 30-day or 60 days to pay. And you will then say, okay, if I buy month 1 10,000 and I'm going to pay it in month 2, then obviously the purchase is in the first month, but the cash flows in the second month. Okay, so that is how inventory will work. Debtors, I sell stock to someone, products. I give them 30 or 60 days to pay, and then I say, okay, this is how I'm going to collect the money, and I will. So the date of the sale and the date of the cash actually flowing in is not the same date. Okay. Then we look at creditors. That is part of your purchase of your inventory. As I said, you purchase and then you pay. So that is your creditors will affect your cash flow. Okay. Then managing current assets, current liabilities is very important so that you can make sure that you have enough cash. When we talk about working capital, as I mentioned, is your current assets and your net working capital. There's a difference between working capital and net working capital. Working capital is all our current assets. Net working capital will be your current assets minus your current liabilities. So if you have current assets of 100,000 and current liabilities of 80,000, it means there's 20,000 Rand left, and that will be your net working capital. So business wants more current assets than current liabilities. Okay. If you remember when we did ratios, we talked about your liquidity and your asset test and your current ratio. So you want more current assets and current liabilities. Then it's important that you collect your cash sooner than later. Okay, so if you think about it, if you buy stock, you will then buy the stock, you're going to sell it somewhere in the future, and then you're going to collect your money from your debtors. But now when you sell it, you'll have to pay for it at some point in time. So the sooner you can collect the money that you made from your sale, then you will have money to pay your supplier when they want their money. So the whole idea, it's a bit of a balancing trick to make sure that you collect your money soon enough that you can pay your suppliers with the money you collect from your sales. If you think about a company like Pick n Pay, they buy their stock, and I know this, they will pay their suppliers in 90 days. So if they buy in January, beginning of January, they will only pay for it end of March. Okay, but Pick n Pay sells for cash. So whatever they bought the 1st of January, they're probably going to sell by the middle of January, everything. So they will have that cash. So 3 months later, when they need to pay their suppliers, they will have enough cash to pay the suppliers. So that is now particular of Pick n Pay. Not all sorts of businesses work that way, but we want to make sure that we collect money before we need to pay. And it's not always possible. Okay, so that time period that you are waiting for your money to come in, but you need to pay your current assets, current liabilities, suppliers, that will be your working capital. So we want to collect as quick as possible, and we want to delay paying the suppliers, which is not that simple. If you delay it too long, they may cancel your facility with them. So you have to make sure that you pay them as long as possible, delay, but you must still pay them that they're happy. Okay. When we look at risk and reward, if your liabilities is more than your assets, then you've got more risk of a liquidity problem. But if you have more assets, current assets and current liabilities, you have less risk because you will have enough cash to cover your current liabilities. So overtrading, it's a concept that you need to understand. This is where you simply put you are selling too much on credit, and you're waiting too long to get that money to pay your supplier. So cash flow problems arise from overtrading. So you are selling too much, and you haven't received the cash yet to pay the supplier. And when I worked for a company a while ago where this happened. We were on construction, and we took on a lot of big projects, and it takes a lot of time. The construction takes 3-4 months from where you spend your money till you collect your money. And that period that you are waiting for your money, that is where you need working capital. And we did overtrade, so we ran into problems with cash flow. We didn't have enough cash flow because we paid our suppliers 30 days, but we only collected our money in 90, 120 days. So if you don't have enough working capital and you sell too much, that is overtrading. Okay, so budgeting. Sorry, I lost a bit of connection there. With cash budgeting, we attempt to overcome the problem of overtrading and to manage our cash flow. So good financial management says, first of all, cash sales is better than credit sales. Now, this again depends on the sort of industry you are in. If you are in retail, yes, cash sales is fine. And you try and minimize your credit sales. Now, if you take, for example, an Edgar's where people have accounts, in fact, the credit is not provided by Edgar's themselves. It's provided by RCS. So when Edgar's makes a sale to you on your Edgar's card, they get the money immediately from RCS, and you actually owe the money to RCS. So that is where the cash sales are better than the credit sales. In terms of debtors, you must be very careful who you give credit to. Okay, debtors are the people that owe you money. You must choose who you sell to and collect outstanding amounts as quickly as possible. Now, in financial management, this is one of the management reports that get produced every month, is what we call our debtors aging. And to say, okay, of my debtors that's outstanding, how much is current, how much is 30 days, how much 60 days, how much 90 days, etc. Now, the longer it takes the debtors to pay you, the more is the risk of bad debts. Bad debts is people that cannot pay you and that you'll have to write off that money. Okay, so that is, you want to collect it as soon as possible. And then third thing is you must spend less cash than what you receive. You cannot spend more cash than what you receive. Well, simply if you don't have the money in the bank, you can't do it. Creditors have longer terms. Try and negotiate with them instead of paying cash or 30 days. Try and get 60 days or 45 days or whatever they will give you. Try and negotiate that. Okay, then it's very important that you do your bank reconciliation on a regular basis to make sure that what you've projected in terms of cash in your bank, that it is actually there. So that is the principle of your bank balance. The budgeting is simply a forecast of what you want to do. Okay. So we look at what we have at the moment and where we are in the future, and that will be our budget that we draw up. Okay. So first is we analyze our income and expenses. We consider the time aspect, in other words, month to month. And when we have the expense, when do we pay? And we'll go through an exercise, but you can see how I'll explain to you how we do that. Okay, then we will do what is called a variance. So variance says if I plan to sell 1,000 rand this month, then after the month end, I will look at how much I've actually sold. If I sold 900, it means there's a variance. I sold 100 less. So that's an unfavorable variance. If I spend, started with 1,000, I sold 1,200, I'll have a variance of 200, and that will be a favorable variance. But we will have a bit more detail on this later. Okay, welcome. So favorable budget is if you spend less than what you planned, or if you got more income than what you planned. And unfavorable, when you spend more than what you planned and you receive less than what you planned. Okay, so let's have a look at the cash budget. Now, we can look at the receipts and the payments, and then we compare them. I don't know if you... So let's look at calculating your receipts. Okay. So we look at, when you have sales, you have cash sales and you have credit sales. Okay. So cash sales, obviously, in a month, if there's cash sales, you receive the money in that month. If it's credit sales, it will be 30 days or 60 days or however you're going to collect it, but that will be a certain collection period. So whether you have the sale in the month, you're only going to collect the money later. Some of it probably in the month, but I'll show you how that works. Okay, if I give you this example, maybe you want to take time and just write this down. Don't think it was in my original slides, because we're going to do a cash budget. So I want you to just write down this information, and then I'll work through the cash budget with you. Okay, if someone can just give me an indication when you were able to write down the information on this slide, and I can continue to the next page. Okay, you've got it written down. Okay, let's continue then. So, okay, what do we have here? With the cash budget, and you'll see how it works, we start with an opening balance. In this case, 1 September 2011 of 22,250. Then we have actual and budgeted sales. July and August. July 125,500, August 150,000. September 200,000, and October 300,000. Okay. So let's assume all of the sales were on credit, and this is how we're going to collect our money. So we say that we're going to collect 25% in the month of the sale. We're going to collect 70% in the month following the sale, 3% in the second month following the sale, and the remainder is uncollectible. Okay, so that is the given information. So now we're going to go and have a look how we're going to collect this money. So this 125,000 in July. We're going to look how we're going to collect this money. Same with the 150 and 200 and 300. Okay. So we do a debtors collection schedule. Now, your textbook may show you a different way. Pardon, but this is the way that works for me. Because I draw up a schedule like this. And I'll explain to you and then you can write it down. So what we say in July, I know my sales was 125,000. Okay, so how do I collect my 125,000? We said 25% in the month of the sale. So 25% of 125,000 will be 31,250. 70% in the month following the sale. 70% of 125,000 is 87,500. And 3% in the second month following the sale. So there I go, and I take my 3%. And there's my 3% in September, 3,750. Okay, we're doing a budget for of September and October. Okay, so so this is I want you to draw this diagram, and then we're going to do the. I've shown you July, and then we're going to work through August together. So just draw this diagram and also do July like I've shown you, and then we'll do August, September, and October. If you can just let me know when you've drawn the schedule or this diagram, then we can carry on with it. I'll explain all the workings. Okay. Okay, let's then continue. Okay, so I've shown you how the first month works. Now let's go and have a look at July. Sorry, August. So August, we say we've got sales of 150,000. So obviously, we're going to start in the month of August. So 25% of 150 is 37,500. So we'll put it there. Then we say 70% is the month following the sale. So there's August. 1 month following the sale is in September. 70% of 150 is 105,000. Okay. Then we have 3% in the second month following the sale. That goes to October. And the balance is not collectible, so you ignore it because there's no cash coming in or going out. So you ignore if it's not collectible. In September, we have sales of 200,000. 25 is collectible in the month of the sale. So we go from there in September, 50,000. 70% is in the month following the sale. So September, October, we're going to collect it in October. It's October. And 3% in the month following the sale. So that will only be in November. So we're not really interested in that, but I've just put the figure there so that you can follow the process. Then we've got October. We have 25% in the month of the sale. 25% of 300,000 will be 75,000. 70% in the month following the sale. 70% of 300,000, 210,000, but that is going to happen in November, which we're not really interested in. I'm just showing it to you. And 3% will be in December. So we are going to, so if you simply add the columns together, so July, we're going to receive 31,250. August, we're going to receive 125,000. Now we're really interested in September and October. Because that's the period that we're going to do the cash budget. So for September, we're going to collect the 3750, the 105, and the 50,000, which gives us 158,750. And then October, we're going to collect the 45, the 140 rather, and 75,000. So we're going to collect 219,500. So that's what we'll be collecting in that month. Okay, any questions on this? Is this quite clear?
Yes, it is.
Okay, great. Okay, so now we'll go to the next slide, and again, you'll have to write down the information. So the purchases and expenses that we are going to incur are as follows. For September and October, we're going to purchase stock 120,000 in September, 175,000 in October. We're going to pay salaries of 22,500 in September, 25,000 October. Advertising 65,000 in September, 72,500 in October. We're going to pay a rent of 4,500 and 4,500. And we've got depreciation of 5,000 and 5,000. Okay, so I also want you to write this down, but I'm just going through the information. So merchandise purchases are paid in the month following the purchase. So what it means, what we've purchased in September, we're going to pay in October. Okay. So that is, we're going to pay that in October, and this we're going to pay in November. Now you can also get, I didn't want to overcomplicate, but because once you understand how you do the debtors, the creditors, if they give you different information, will work on the same principle. Now, seeing that we're paying this a month later, so They've given us the information. The purchase for August was 20,000, which means we're going to pay this August in September. Okay, so we're going to pay that in September. Okay. Then apart from those expenses, you say we're going to buy equipment of 5,000 Rand, purchased during September. We're going to pay the 5,000 in September, and we're going to get a loan of 20,000 in September, and we're going to repay it in November. And interest on the loan is calculated at 600 Rand a month. Okay, so I want you to write down this information, and then we carry on. Let me know when you've finished writing it down. Are you done writing it down?
Yeah.
Okay, then we can carry on. Okay, so this is what a cash budget looks like. Okay, so we start with the opening balance. So let's go to the first page. There we say we had an opening balance of 22,250. Okay. Okay, what I want you to do is write down everything but exclude the figures. Just do the table and then the figures that I've of the descriptions I've got on the left. And then I'll show you where we get all the figures from. Please. Ah, pardon. Just let me know when you've finished writing it down. Okay, so let's go through it. So let's start. Okay, so I've already said the opening balance comes from the first page. There's our opening balance of 22,250. So with a cash budget, you can think of your own personal finances. Month end, you start your balance at the beginning of the month, whatever amount of money you have in the month. You collect cash. Okay, so in this case, we say we collect debtors of 158,750. Where does that come from? There's our 158,750. Okay. And the next month we're going to collect 219,500. So let's go to that. There's our 187,750, and there's our 219,500. Okay, so that's the money we're going to collect from our debtors. Then we had a loan, that's from the previous page. We said we acquired a loan of 20,000. There's our 20,000 loan. And we're going to receive that money into our bank of 20,000 in September. So we can add up the receipts, 158,750 plus the 20,000. That gives 178,750. So that's the money we receive. So how much cash do we have? We have the 22,250 plus the 178,750. So that's how much cash we have. Okay, what are the expenses now? Okay, so there's our merchandise purchases, 90,000. Where does that come from? Okay, we say that we sorry, that figure is wrong. Just check. And that should be 90,000. I do apologize. There's our purchases. That should be 90,000. Let me just try and correct that. And that's the 90,000 that we are collecting. Sorry, paying. The August ones we pay in September. You pay 1 month later. So there's our 90,000. And now our purchases for September, we're going to pay in October. There's October, the 120,000. Okay, so that's where that amount comes from. Then we go to our other expenses, salaries of 22,500 and 25,000. There's our 22,500 and 25,000. Next expense, we said there's going to be advertising of 65,000 and 72,500. There, advertising 65,000 and 72,500. Then we have rent, 4,500, 4,500. Okay, rent 4,500, 4,500. We said we're buying equipment for 5,000 Rand. There's our equipment that we're buying for 5,000 Rand. The next month we don't purchase any equipment, so that's a 0. Then we calculate our interest on the loan. Okay, the interest is 600 Rand a month, so we're going to pay 600 Rand interest and 600 Rand there. The loan repayment, we say we're going to only repay the loan in November. We only concerned with October, September, October, so there's no loan repayment there. Only go to the next month. And then depreciation. So we've got 5,000, 5,000. Remember I said the depreciation is not a cash flow item. Therefore, you ignore depreciation. Okay, so if I add up all my expenses, it comes to 187,600 for September. So if we take the 178,750, there's a typo somewhere, plus the 22,500, and we subtract the 187,600, that leaves us with a closing balance of 13,400. Okay. So as you know, the money you've got left at the end of the month before payday becomes the opening balance of the next month. So we will start our opening balance with 13,400. And there's our collections of 219,500. Our expenses of 22,600. And that leaves us with a balance of 10,300 that we've got left at the end of the period. Okay, that in basic is what a cash budget looks like. And this is how we do the calculations. Any questions from your side? No questions?
Oh, I'm good, thank you.
Okay. Okay, there, I want you to go to your textbook, activity 4A, on page 69. I'll just talk you through some of the information there, and then you can practice that on your own. Okay, so give you a moment to open your books and get it ready so we can go to that activity. Okay, so activity 4A, they tell you Benmore traders used to have a trade receivables collection as well as a trade payables settlement period of 30 days. So what they're saying is you're collecting your debtors in 30 days and you pay your creditors in 30 days. Financial manager prepared the following two incomplete budgets to help her with a very important decision: whether or not the trade receivables collection period should be extended to 60 days in order to boost sales revenue, whether to keep the collection period constant at 30 days. Okay, so this is one of the ways that you try and get more sales, is to extend the credit period so people have longer to pay, and then you hope that they will buy more. Okay, so let's look at scenario 1, where they say keeping the collection period constant and causing no change in sales. So if you look at the first column of March 2008, okay, you've got sales, and they say everything's on credit of 175,000. Then they give you a cost of sales of 87,500. Because the gross profit is calculated as follows: sales divided by cost of sales. So 175,000 divided by 87,500. Take my calculator, 175,000 minus 87,500. So that gives us a gross profit of 87,500. And then we subtract our expenses of 32,000 minus 32,000. And that'll give you a net profit of 55,500. But this is now sales and your net profit. This is not cash flow. So we're going to be looking at the cash flow on how we're going to see if we should extend the credit to 60 days instead of 30 days. Okay, so if we look at the second page, the next page, where they say note all merchandise is purchased on credit and sold within the same month. and there was no outstanding amounts from debtors at 1 March 2008. So how are we going to collect our bank balance, our cash balance? So they give us a 200,000 opening balance for the month. Then expenses paid in cash. If you look at the above the net profit, they say it's 32,000. So you'll put your 32,000 in that column in March 2008. Trade payables in cash. Okay. So we normally pay trade payables 30 days. But they say there was no opening balance in trade payables. In other words, we're not going to pay anything in month 1. There's going to be 0 for trade payables in cash. And then receipt in debtors. Again, there was no balance there, so we're going to leave that at 0 as well. So for the first month, we only have our expenses paid in cash. Okay. So it will be 200,000 minus the 32,000 Rand. Plus our net profit of 55,000. No? Put you out there. The net profit is not in play here. We have the cash on hand of 200,000 less the expenses of 32,000. So we're going to be left with 168,000 closing balance for the month. Okay. So let's go to April 2008. Okay. The same, the sales 175,000, cost of sales 87,500, gross profit 87,500, net profit 55,500. That stays the same. But let's look at our movements for the month. So the expenses paid in cash will be the 32,000. Trade payables settled in cash. Okay. So we purchased, our cost of sales is 87,500. So we're going to be paying in April trade payables of 87,500. And we're going to collect, that 87,500 comes from March. And we're going to collect the 175,000 sales in March. We're going to collect that in April. So what do we have in that block there? The expenses in cash of 32,000. Trade payables of 87,500. And cash from debtors, 175,000. Okay, and that will give us the opening balance of 168,000 plus our 55, sorry, plus minus the expenses of 32,000 minus the trade payables of 87,500 plus in 175,000 that we collected, and that gives us a closing balance of 22,3,500. Okay, so you can continue doing those sort of calculations, and you can see how it goes from month to month. And you can, so I want you in your own time, because it's no point in me sitting here and you staring at me completing it. I want you to complete the rest of May and June. You can look at the answer on page 284 of the textbook. Okay, so let's go to the next month, the next scenario. They say, okay, we are going to now extend the debtors. Okay. We're going to extend that to 60 days. The creditors will remain the same. Okay. So for month 1, activity, the 175,000 will stay the same. 87,500 stays the same. Net profit of 55,000. The first month stays the same. Okay. So let's go to the second month. For the second month, we now have sales of 190,000. Okay, but we are now collecting the money in 60 days. So if you go to the March sales, we only collect that in May. And the April sales we collect in June. Okay. The cash expenses, you still the same every month. Okay. 32,000 every month stays the same. Our trade payables in cash. Okay. So we pay that 30 days. So in month March, it will still be 0. Month April, it will be the 87,500. In month May, it will be the 95,000. And in month June, it will be the 110,000. And the cash receipts from trade, we now receive it 2 months later. So for March, there will be nothing. For April, there will be nothing. And then in May, we're going to collect the 175,000 from sales in March. In June, we're going to collect the 190,000 from sales in April. Okay, so I want you to practice that and see what the answer. Then next week we will work through some more of the exercises so that you can get up to speed on how these cash budgets work, because you should be able to do a cash budget. Okay. Goodness. Okay. In your own time, you can work through example 4B. This is a personal budget, so you can just look through that example on how it works, but I've already explained how a cash budget works, so it is quite simple. Just go through the example, and if you have any queries, we can discuss this next week. Okay. Next week, we will continue with cash budgets in more detail and also looking at the variances. Okay, any questions on your side?
Are we gonna do any revision work week commencing the 3rd of April just to prep for the test?
Yes, we will do so.
Okay.
So that's not next week, it's the week after, is that correct?
Yes, that's the week after, because we
Yeah.
commence 27th.
Yes, we will do some revision. I'll get you some sort of mock questions, as we call them, so that you can see more or less the type of questions that you will be getting. But we will do that 2 weeks from now. Okay.
Thank you so much, Carl.
Okay, thank you. Thanks for attending and have a good evening.
Thank you, Paul.
Thanks. Okay. Goodbye.
Bye.
Thank you. Bye.
Bye.